So I think I can divide my answer into 3 points, and these are the 3 points which are very important for any company when they're looking at they're comparing the GRIP deal versus a bank or an NBFC deal. And I think this question has come up very so many times to us, Nikhil, in our questionnaire as well, in the current Q&A as well. So I think the first important point why company look forward working with GRIP or a model like GRIP is that our model provides them to keep their model very asset light. Because in our case, these companies are not owning the asset. The asset is owned by the LLP, which we create for our investors. So, the business model becomes very asset light. And being an asset light model gives them power of expansion really quickly into the market, right? So if we can think of a company like IPL Truck, right, which is procuring trucks, or a company like Fabelli, which is using fabrication machines, a lot of fabrication machines. And every time they have to buy a fabrication machine, they have to put money from their own invested capital, versus they go to a company like Grip, which is owning the asset and quickly enabling this payment for them. They're happy with it, right? The second point will be the speed of investment. If you look at Grip's platform and what the deals we have done till date, the maximum time we take to fill a deal is between 15 to 20 days. And before that also, our processes are quite quick when compared to a bank or an NBFC. So that's why if you're a founder of a really high growth startup, or you being a founder of a great big company which is NSE listed, you'll always be looking for the speed factor when you are in your expansion phase, or when you are thinking of exploiting the market with your business. So the speed is very important. We are able to provide these companies with speed. The third point is volume, and the kind of the tenures in which we provide the money to them, right? So if you look at our Furlenco investments, we have done first Furlenco deal of 50 lakh rupees in the starting of our company. Then we have done a 2 crore deal with them, and we'll again launch a deal with them. So we are really, really flexible towards the company's needs. Whenever they require money, they can directly come to us, and if we have done their due diligence and everything else, then it's a quite speedy process for them, and we are readily available with the access to capital for them. So this again, gives us a 1 point higher than the bank or an NBFC, when compared to a bank or an NBFC. So I think these are the three major things why all these companies look forward to work with Grip, and they are working with Grip and raising capital with us, again and again.
And if I can just add to that, Vic, I think giving the example of Everest Fleet, which is a company which is Uber's largest fleet partner in India, when they came to us for leasing assets, they have about 720 vehicles on loan from HDFC Bank, right? But their ambitions are to go to 2,000 vehicles, and they wanted to lease from us. The reason was very simple, right? And the promoter of Everest Fleet also happens to be a shareholder of Grip, and hence a very, very honest conversation with him. We were able to understand that HDFC Bank is happy to provide more capital, but they also want a promoter guarantee in each transaction, right? For some of these companies that are scaling to very large sizes, it is not possible to follow some of the traditional expectations of a bank in terms of getting a promoter guarantee. You have to look at things differently. In this situation, we are leasing to the company, or we're creating a lease option for the company, which is only 200 basis points higher than what an HDFC is leasing. But the company quality, it's a profitable company with a 16% EBITDA, 3.5 crores in monthly revenue, right? So as we create those opportunities, the returns will obviously be lower, the risk will be much lower, but we are competitive in a total offering with other other financial products. And finally, while we'll not get into the detail, leasing offers certain tax advantages to companies, because you can claim the lease expense as a expense in your P&L and reduce the corporate tax. Hence, on a post-tax basis, leasing can sometimes be much more effective than taking a loan.